When it comes to high-yield investments, real estate investment trusts, REITs, are often a popular choice for investors seeking stable income. Realty Income, ticker symbol O, and Essential Properties Realty Trust, ticker symbol EPRT, are two well-known investment-grade triple net lease REITs that have consistently delivered strong performance. In this video, we will compare these two REITs and provide insights into which one may be the better buy at the moment. This is the Bullish Aristocrat. And in this channel I would like to share my investing journey, and give you all the tips and advice I wish I knew when I first started investing. So if you find that interesting, then please subscribe to the channel and like this video to help support us in reaching more people. Make sure to press the notification button to stay up to date with new videos that will be uploaded. First, let's take a look at the business model of the two REITs. Both Realty Income and Essential Properties Realty Trust follow similar triple net lease business models. They acquire single-tenant freestanding retail properties and lease them to tenants, ensuring stable profit margins as tenants are responsible for recurring property expenses. This business model has proven resilient during economic downturns such as the Great Recession and COVID-19 lockdowns. Realty Income, being the largest triple net lease REIT globally, enjoys the advantage of diversification with 12,492 properties and 1,259 tenants across 84 industries. Approximately 91% of its total rent comes from recession-resistant and/or e-commerce-resistant tenants, with around 41% of rent derived from investment-grade tenants. On the other hand, Essential Properties Realty Trust is smaller in size with 1,688 properties, but still offers sufficient diversification with tenants spread across 348 individual tenants and 16 industries. While EPRT lacks exposure to investment-grade tenants, it focuses on strong unit-level rent coverage and a lengthy lease maturity profile. Most of its tenants are service-oriented, experiential, or grocery businesses, making them resistant to e-commerce and recession. The balance sheet strength of a company is important to consider when evaluating investments. In this case, Realty Income has a better credit rating of A- compared to Essential Properties Realty Trust BBB-. This means that Realty Income can borrow money at a lower cost, which is beneficial for their investments. Realty Income also manages its debt well, with an average time of almost 6 years for the maturity of its debt and a low percentage of debt with variable interest rates. It has solid financial metrics, such as a fixed charge coverage ratio of 4.6x, which shows its ability to cover its fixed expenses, and a net debt to annualized pro forma adjusted EBITDA ratio of 5.4x, which indicates its debt level relative to its earnings. On the other hand, Essential Properties Realty Trust maintains a low leverage ratio of 4.1x, which means it has less debt relative to its assets. This gives the company flexibility for growth without needing to issue as much equity. It also has minimal debt obligations in the near term and all of its debt is unsecured, which means it doesn't have specific assets tied to the debt. In simple terms, Realty Income has a stronger financial position with a better credit rating and well-managed debt. Essential Properties Realty Trust has less debt and more flexibility for growth. Now let's talk about the dividends. Realty Income has a strong track record of increasing its dividend for 29 consecutive years, which is quite impressive. It is also recognized as a member of the Dividend Aristocrats, a group of companies known for consistently raising their dividends. Looking ahead, Realty Income is expected to continue increasing its dividends at a similar rate as it has in the past, with both the dividend and adjusted funds from operations, AFFO, per share growing by around 3 to 5% over the next few years. On the other hand, Essential Properties Realty Trust, despite having a smaller portfolio, has the ability to use its balance sheet to generate faster growth. It is projected to achieve higher growth rates for both AFFO and dividends per share, with annualized growth ranging between 4 to 7% in the coming years. When it comes to dividends, Realty Income is king. Realty Income has a long history of increasing its dividends, and it is expected to continue doing so at a steady pace. Essential Properties Realty Trust, with its smaller size and flexibility, has the potential for even faster growth in its dividends and earnings. In conclusion, both Realty Income and Essential Properties Realty Trust are high-quality REITs that have consistently delivered steady dividend growth. However, there are certain factors to consider when determining which one is a better buy at the moment. Realty Income stands out with its larger portfolio, diversified tenant base, and higher credit rating, offering a more conservative approach to weathering economic downturns. It also provides a higher dividend yield and is cheaper on a P to NAV basis. On the other hand, Essential Properties Realty Trust offers stronger growth potential, with its smaller size allowing for more agility and higher growth rates. Ultimately, the decision of which REIT to invest in depends on individual investment goals, risk tolerance, and market outlook. It is important to conduct thorough research, analyzing factors such as the business model, balance sheet strength, dividend and AFFO, growth outlook, and valuation. Understanding the risks and opportunities associated with each REIT will help investors make an informed decision that aligns with their investment strategy. Thank you so much for watching this video till the end. If you found it at all helpful, then please hit that like button and subscribe to the channel to always be up to date with new videos that will be posted weekly.